Hi, I'm Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And you guys are going to get tremendous benefit from my friend who I'm interviewing today. His name is James Kandasamy, and he's my friend because he's a member of my multifamily boardroom mastermind. We're actually in a deal together. He's just a great guy, and I'm really blessed to have him on the show today. He's got over 1,000 doors, $65 million portfolio. He's a real hitter in this space, so we're going to have a lot of fun today. James, welcome to the show, my friend.
Thanks for having me here, Rod.
Absolutely. Absolutely. So, the topic of today's show is going to be passive investing in commercial real estate, which I know you wrote a book about, which we'll talk about at the end. But, let's talk about how, let's say, you're an accredited or a sophisticated investor and you want to invest passively in a syndication, in somebody's deal. And guys, I'm here to tell you that you shouldn't invest in anything unless you know this business a little bit, okay? That you've done some homework, you've looked into the operator, you've looked into you know a little bit about the deal structure and understanding, what's a good deal and what's not a deal before you get in bed with somebody. And so we're going to talk about all that today. So, James, I guess let's just get right into it. I mean, we don't have to, normally I would say, tell us about your history and how you got in the business, but I don't think we have to do that today. I think let's just go right into some questions about passive investing. Let's say someone's thinking about it. What would you recommend they do to get started?
Well, I mean, there's a lot of consideration when you want to invest passively, especially with now the buzzword is syndication, right? Where anybody can invest passively in any syndicated multifamily deals. Mm-hmm. And I think key things that they want to look at is, how do they consider deals, right? And what are the sponsors that they want to invest with, right? As you mentioned, who do you want to get in bid with, right? So right. Let's go through each one of those. Those are two big things that I think we should be covering as part of our discussion here. One is the considering deals, right? What kind of deals do you look at, right? I mean, there are three primary types of deals that exist in the market right now. One is core, or something called a yield, where the deals are stabilized and you get cash flow from day one, right? So, and the other one is something called value add, and the third one is called a deep value add. And value add is more of a combination between a yield and a deep value add. Whereas deep value adds where, it's very, very opportunistic and you get the highest equity appreciation compared to cash flow, right? So if you look at yield plays or core deals, you get cash flow from day one, but there's not much of equity appreciation unless the market appreciated, right? So right. I've seen many, many times where people buy a core deal and they said, we made 300% in the last 3 years, but actually they didn't do much to the deal. Actually, the market appreciated, right? So same thing on a value add deal where, the sponsor.
Hold on. Let me stop you for 1 second. So guys, a yield deal, like an A-class property would be a yield deal. Okay. It's a property where there really isn't much opportunity, or it's a property that's already been repositioned. You're just taking it over and collecting rents and banking on appreciation. So that's a yield deal. The most common deal in multifamily is a value add. So let's talk about a value add now, James.
So value add is a combinational where you get cash flow at the same time. You also get equity appreciation. I would say is a better in terms of safety wise, in terms of margin for error, because you have that buffer because you're adding value to the NOI, right? We're going to push up the NOI, and that's the powerful force appreciation in commercial real estate.
Right.
But value add, there's two types of value add. When you go more into the deep value add, you have to do bridge loans, you have to do short-term loans, and you may not get paid for the next 2-3 years because, the sponsor is trying to stabilize the deal. That's more of the deep value add.
Right. So let me dig in there for a minute, James, because you're saying some things that might go over the head of some of my people. So in a value add, maybe you go in and you would put in new plank flooring and maybe put in new fixtures and paint the outside and do some landscaping and resurface the parking lot. In a deep value add, you might have a property that's, if you've got a property that's unstabilized, if the vacancy is high enough, you can't get regular Fannie Mae and Freddie Mac financing, which is why James was talking about you need to go out and get bridge debt. You've got to get a bridge loan. Then you go in and do, a deep value add could be a complete remodel in an apartment. I mean, I know, sometimes you can spend as much as $10,000 to even $20,000 per unit in a deep value add if you're doing massive remodel work. And they are riskier for sure, especially if you're not an experienced operator. But there's an opportunity to really massively force appreciation, and that's the term he used, guys, is forcing appreciation. That's what's beautiful about this space is that you have the ability to do that by adding value to a property. So go ahead and dig into deep value adds a little more than that, James.
Yeah, I mean, so deep value add, you have a lot more equity appreciation, right? So your equity might be doubling in the 2-3 years time frame. Whereas on the core yield side, you get a lot of cash flow. You have a lot more thin equity appreciation. You may not have any equity appreciation unless the market appreciates, right?
Right.
So what I'm saying is any passive investors really need to look at their own life cycle, how much money they have, where they are in their investment cycle of their life, right? So let's say, for example, if you're very young, you only have like 200,000 to invest. You can't really, put that 200,000 into a cash flow deal and expect it to, sustain your life and you can retire or you can achieve financial independence, right? So what I'm saying is for people like that, where they have limited amount of money, they are early stage, they have a W-2 job, which is taking care of them in terms of income, they can take a bit more risk and invest more into the deep value add or value add space compared to core yield deals, right? Whereas someone who has a lot more money, who have like $1 or $2 million to invest, and they are more in the later cycle and they want to retire and they do not want to do work, they don't have any job, they want more stable, less risk, they can invest more on the core and yield type of deals. And so the alignment of deals with the investor's life cycle is very, very important. And a lot of people don't understand that because
let me
invest into everything that they see.
Let me enhance. Let me enhance what you just said just a little bit because guys, you really should have, depending upon where you are in the cycle of your life, like you just said, James, you'll find that your investments strategy is going to be different. Like you said, if you're younger, you can take more risks. And I like to equate it to buckets. You should have a risk bucket, that your money that you risk, you should have a risk or growth bucket. Then you should have maybe a security bucket, money that you don't spend. And then of course a bucket for your lifestyle. But it really depends on where you are in your, your age, your tolerance for risk. The only thing I would add is, yes, you can do a deep value add deal, but just a word of caution, you really know the operator, because that, if the operator is undercapitalized, if they don't know how to do a heavy reposition, they get into something they haven't done before, and, the cost, you can have cost overruns and they can get in financial trouble, especially if they've got high vacancy. And so, would you agree with that, James?
Oh yeah, absolutely. That's one thing that I want to mention. Is, I've seen operators who have done core deal type or yield deal type, 2 or 3 times, and then the fourth one they suddenly want to do a value add or deep value add, and they fail miserably just because it's a different skills. Right. Buying a stabilized property versus turning around a demographic or turning around tenants, turning around a property is completely different skills, right? So you need strong property management, you need strong people manager, you need control over the property management.
Strong organizational skills. I mean, if you're managing a big project, a multi-million-dollar reposition, you better be great with project management. You better know how to sequence the work,
Correct.
So you're not in there, putting in carpet before you paint or,
Exactly.
As examples. I mean, that's an extreme example, but you really need to, so the point here is, if you're going to invest passively in somebody's deep value add, make sure you check out the operator, look at their history. What have they accomplished in the past? to make sure you're not getting in trouble. Now,
Yeah. Yeah.
what do you
Exactly.
suggest? What do you suggest, James, as far as, you know, enhancing their skill sets? I mean, do you think it makes sense for them to learn the business a little bit and really understand how to, you know, even do a cursory evaluation of a deal to make sure that they're checking the operator, they're checking what they're doing?
Well, I mean, there's many ways to check the operator, right?
Mm-hmm.
But the best thing I would say is just talk to the current passive investors who have invested with that operator, right? See
Yeah,
whether
good advice.
that's the best way to find out, because there's no other way to really find out about operators, right?
Mm.
Rarely any operators publish all their track record, right? A lot of times they just show the current deal and this is what we're doing.
Yeah, good point.
And a lot of times operators use, whenever they KP for other deals, or they invest in passively in some other deals, and they take that unit count and add into their unit count. So a lot of times I see operators claim they have 3,000 units, they have done 1,000 units, or they've done 500 units, but actually when you dig deeper, actually they were just investing passively, right? So keep in mind, passive investment is completely different skill from a sponsor skill.
Right. And
right?
to you know, there's passive investment, and then there's the KP, key principal, or the GP, the general partnership. And those are the syndicators like yourself and I that put these deals together. And
Correct.
yeah, very big difference, very different skill set. Now, I will say this though, James, is that if you invest passively in someone's deal, it does enhance your experience, because you're seeing the back, you know, what's happening in the back. You're getting some additional experience. The banks will look at it as a level of experience. And, you know, and I know in my deals, you know, when we bring in passive investors, I make a conscious effort to do some education as part of that process, you know, so that, you know, it's like anything. Anytime you add value and you educate, it comes back to you. And if you do that with your passive investors, if you're a syndicator, you know, it's a really smart move. You're bringing them along. You're raising their level of competence. Would you agree with all that?
Yeah, absolutely. Absolutely. Okay. Yeah. I mean, you are good in doing that, right? But
right.
I mean, not everybody gets that kind of opportunity, right? The thing is, you have to see what's behind the operation. There's so much things going on in any sponsor's work. There's just too much things that passive investors would not know. But if you're able to share that experience and share their skills and what are the challenges that you're seeing and how are you overcoming it, that's the best way to learn.
Yeah.
But just be aware that, you know, if a sponsor on the deal number one, they want to do a value add deal or a deep value add deal, and they're buying a large portfolio, and that's basically a red flag, right? So you want to really make sure that the sponsor who's doing their first deal know what they're doing. You know, at least they're starting something small or starting something on the safer side of it, right? I mean, market is very hot right now. Everybody want to do deals, right? So,
right.
But not everybody can be a deal sponsor, to be upfront with you, right? It's a lot of skills behind them.
Sure. And you know, there are a lot of people out there as operators, as syndicators, that started after the crash and they've not gone through a crash yet.
Exactly.
And you know, we're seeing, we watched somebody do a presentation on a deal, and they did, and we asked the question, did you stress test it? And they said no. And guys, if you're doing a deal, you better, by God, you better stress test it. Meaning, you know, what does it look like 15% vacant? What does it look like if your rents contract? You know, and see what your break even point is and how far you can go. And if you're not doing that, or your operator's not doing that, they're taking huge risks. And I will tell you, and I'm sure you have, James, seen this as well, where you've been in the best and final on an offer on a deal, and you're scratching your head when you see what it trades at. And, you know, they're paying millions more than you thought was as far as you could go. And you're like, what are they thinking? And there's a lot of that going on right now. So you want to be very, very careful.
Yeah. Especially on the bidding war deals, right?
Right.
You basically paid the highest.
Right.
That's it.
Right. Well, that's exactly right. So, you know, I know that, you know, you've been very successful, and I've seen some of your turnaround projects, and you've done before and after pictures, very, very nice work. And you know, and so, you know, what are you doing to find deals yourself? Let's talk about finding deals. What do you do to get, you know, properties that you can add value to? Because you've been very successful at it.
Yeah, so we usually like to look for off-market deals, right? And I've been very successful in the early part of my acquisition part, where we bought like a couple of deals off market directly from sellers. So we work really hard to find sellers. So once we do that, we start getting deals from brokers. but even deals from brokers, we avoid trying to go into the
Bidding.
bidding war, right?
Right.
So
Right.
even though there's a bidding war going on, we have a much more higher advantage just because we have our own operation. So we get a lot more loan proceeds from there, right? At the same time, we have told the broker, hey, we have a property nearby, take this deal off market, and they will do it off market as well, even though it's on the market, because they know you are the best qualified buyer, so they will do it. So we try to pull everything off market, avoid the bidding war, try to use our operational efficiency to get a much better deal out of a deal, right? So these are the things that we're doing nowadays just because the market is so hot. And a lot of deals we just sniffed at and we said, no, we're not going to look at it because that's just not much of value add to add in. And key thing we look for is what is the buffer that we're getting going in today. So we may buy it at today's cap rate, but we look for the spread from today until the next 2 years. Without any rent growth, we look for the spread at least 1.5 to 2% of cap rate increase or property cap rate increase based on today's price without any rent appreciation. So that's what we look for. If we can see a clear trend of upside, we'll pursue aggressively.
So
But a lot of deals, there's just no upside.
In your definition, what's creating that upside? And if you're not looking at rent growth, what's creating that upside? Your operational efficiency, your ability to decrease expenses, your ability to manage it better?
Yeah, the ability to manage it better by decreasing expenses, at the same time, ability to put in capital expenses and push up the rent.
Got it.
These two would be where you increase the NOI.
Right. Okay. You just said without any rent increase. So I was just, so, I know you're a great operator and you can manage much more efficiently than the average for sure. And that's really important, guys. I mean, any improvement to the NOI is an exponential improvement to the value. And you improve the NOI, not just by increasing rents, by also decreasing expenses. So management efficiency is very important.
Yeah. And also, of course, you need to have a very strong underwriting skills, right? When you look at P&L, Robert Kiyosaki say one of the most important skills to read financials, yet not many people knows how to read financials, right? Looking at rent roll and looking at T12, where do you identify the inefficiencies, right? And how do you do market comps? A lot of people like to use CoStar a lot and they believe a lot in CoStar, but
no.
Well, let me tell you, I don't have a subscription to CoStar.
Well, no, but as far as market comps, I'm flying to Dallas tomorrow for a deal we've got under contract, and we're going to go visit every comp in the market.
Correct.
You've got to see who your competition is. You've got to see what their vacancy is, what their amenities are, what they're charging, and that's how you do market comps. You agree?
Yeah, absolutely. And right now, because the market is so hot right now, right? So even brokers are telling you, even without looking at the property, you need to pay me 200, 300,000 day one cash. And people find it, everybody's really pushed to do deals. At the same time, they are not doing very strong due diligence. Their money is stuck. And even though they find something throughout the feasibility process, it's too late, right? So they just go ahead and do it. As I said, all this is good when market is good, but when market turns around, in fact, market's already turning around right now, right?
Right. No, I was just reading in Business Week that that new home sales have fallen off a cliff in some of these hot markets, which is a big precursor to a contraction. So
contraction, yeah.
So very, very, very good.
Yeah.
Well, I know that. You've got a book out. It's passive investing in commercial real estate: the insider secrets to achieving financial independence, and it's on Amazon, guys. And James is a friend, and it's definitely got my endorsement. And I appreciate you being on the show, brother. It's always fun to talk to somebody that's making it happen. Let me ask you this: if what do you think is the most common reason people fail in this business?
Buying based on emotion, I guess, not numbers. Yeah. You have to look at the numbers. And the other thing that I think is very important is sometimes people look too much into the numbers, right? So a lot of times if you see a sponsor explaining their deal, they just talk about the numbers. Hey, what about the demand side of it? What about the renters, right? People don't talk about household income. What is the household income? How many % of renters are living there? Nobody talks about that. Everybody just talk about, this is what I'm going to give you. This is what it is. This is a great market. What does a great market mean? Great market supposed to be turned into demand, right? So people talk about the numbers, but people forgot about the demand, because the renters are the ones going to pay your income, and that's where you're going to get the investment returns.
You've got to look at jobs. You've got to look at
Exactly.
median income. You've got to look at the household makeup. You've got to look at the, the median home price. You've got to look at the local vacancy rates. I mean, there's some things you got to do. You can't dabble in this business. So, a lot of my listeners are aspiring real estate investors. Maybe they could be passive, maybe not. But regardless, what advice would you give them? Final advice would you give somebody that's listening to this show that knows they want to get into this business? What would you say to them?
I would say, if it's a choice between whether you like to succeed or whether you want to succeed or whether you must succeed or not.
Oh,
right?
Nice definition.
The guy who must succeed is the guy who will succeed. I mean, the guy who like to succeed may do one deal, but after that they are done, right?
Or if they even do one deal. I love the saying, you've got to want to succeed as much as you want to breathe.
Yeah, exactly.
That's a must. That's the must. You got a must. Okay. Love it, buddy.
So
let me ask you one last question. Let me ask you one last question. If you were going to talk to your 20-year-old self, knowing what you know now, what would you do differently?
I wouldn't have done anything differently.
No, you wouldn't have bought more. You wouldn't have held on to everything.
Well, the skill to really turn around a property comes from, where did I learn my project management, right? I learned from a corporate job, right? The learn to manage people, the learn to how to underwrite deals. It takes a process to learn all that, right? I mean, you can probably find a mentor in the beginning and learn all that in the beginning. Yeah, that maybe is one thing, but for me, I think a lot of experience from the initial part of my life contributed to quick success in the later part, right? I mean, people don't see how much hard work you put in the beginning.
Oh yeah.
To go through different businesses, and we failed so many times, and now but people just look at now, right?
They look at the success. They think it's all easy. They don't realize how many failures there were on the way to that success. And now I'm really glad you said that. And it all builds on itself.
Exactly.
When I lost it all in 2008, it was still a seminar. I learned a lot. Okay. Yeah. And so, it's when you look at life that way and you don't fear failure, you realize that we all fail our way to success. That makes it less intimidating. It was great to have you on the show. And guys, definitely look for his book. We'll put the title again in the show notes. And James, I'll see you in San Diego at our next boardroom, my friend.
Sounds good.
Thanks,
Rod. Nice chatting.
You bet, buddy. Take care. See ya.
Okay. Bye.
Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through real estate investing.